And we're back with you on our morning edition here on Market Day Report. Thank you so much for joining us. And we have a very special guest in the studio with us today. Well, it's been a little while, but we have Chris Swift with us in person from Swift Trading. Look at this. There he is, live and in color and everything. Wow, how are you?
It's just like everything's back to normal, isn't it?
Oh, my gosh. I have to remember how we do this.
Absolutely.
When we talk face to
well,
face.
sure glad to be back.
Oh, it's nice to be getting somewhat back to normal again.
Good,
so
good.
I'm really glad you could make it in and talk with us. I wish the markets were a little stronger for you to talk about.
They were there all week long last week, so we just get a little bit of a reprieve this week.
I think the word got out that you were coming in today.
Let's hope that's all yet.
Let's take a look at the corn market right now and see what we're talking about. On the corn trade, we're getting kind of weak in the knees here, Chris. We have July now down 6 3/4. We're at 725.5 per bushel. Look at that December contract. Down 17.5 now at 619. What happened here?
I think a little bit of the rain, some of the moisture that we got over the weekend, as well as China canceled some of their shipments that they had for the 2021 crop year, and they pushed that over into the next crop year there. But I think in last week we had some solid gains across the board. So just a little bit of profit taking, reprieve in the planting to see what we get this afternoon on our crop progress report, and we're just going to have to see how much more rain falls.
I had one analyst this morning on my radio show on Commodity Wrap on Sirius XM, that's channel 147. They mentioned that they thought maybe corn planting would be past 70% this week. What do you think?
Oh, I would agree.
Really?
As dry as it has been everywhere, and I've seen the planters rolling, and we were up in West Tennessee, and it's a good 3-4 inches already out of the ground. So,
okay.
Yeah, it's. I think they'll have a good start on it.
On the soybeans, they thought maybe half would be planted by this week.
And usually beans are a little bit later than that, and we'll get another section of that, a percentage of it after the wheat harvest. You'll get some no-till beans to go in there. But, yeah, you'll probably a good half on the beans as well.
Right now, July soybeans are unchanged. We're at 15.89 3/4, and November new crop soybeans, just like in the corn, the deferred contract seeing the most weakness today. November down 10 now at 14.23.5. You know, I heard it got pretty nippy in the northern half of the corn belt.
I did. It has stayed that way in the low 30s sometimes, but I don't think there's been any kind of freeze damage. And if the corn has been planted, then what they're really looking for is some kind of warmth to germinate the seed there. So.
Now, speaking of the cold, I heard from John Jenkinson this morning that it got kind of frosty in northern Kansas overnight. And let's look at what the wheat market is doing right now. We have the July Chicago wheat dropping 23 3/4 cents at 738. And in the Kansas City market, with our quotes provided by bar chart, you have July down 21 at 715 3/4. Spring wheat market in Minneapolis has July now currently trading 29 1/4 lower at 768 1/4. Apparently, the market doesn't seem too concerned that it got a little chilly.
You know, I don't think so. And what we seem to see in the wheat market is price. That price for wheat is a very attractive price for a lot of wheat farmers. So I can see where you could get some new crop selling coming in on that with over $7. And they probably tightened up the basis just a little bit. So, yeah, I can see where selling would come in on that.
It's kind of that time of year, isn't it?
It is.
Yeah. All right. We'll come back here in just a moment. We'll talk more with Chris Swift about our livestock trade. We'll see what's going on there. You might be surprised. We'll be right back. We're back with you talking with Chris Swift of Swift Trading in Nashville. He joins us in studio today. Let's take a look at our live cattle board and see what the livestock trade is doing. We saw all the weakness, which is gaining steam to the downside in the grain markets. On live cattle, we're going higher. I guess that's not to be unexpected. We have June live cattle now up $1.05. We're at 117.07 per hundredweight, and that's within a dime of our high of the day. August now up 67. We're at 119.52. We're leading the charge by the nearby contracts, which a lot of analysts will tell you is more of a bullish sign when you have bull spreading. On the feeder cattle market, we still have the August contract now $2.20 higher. We're at 146.47. And we're off of our high of the day by about half $1, but off of our low by $1. And compared to the way we closed last Friday when we were, over $3 off of our high of the day, today looks a little better, but what do you read into it now?
Well, we're carrying a $3 premium, $13 premium August over the May contract. And there seems to be in the industry out there that we have ample plenty cattle to work with today, but in the coming future we'll have fewer and fewer. And we look at the situation similar to Australia. Australia went from a massive drought and liquidation to all of a sudden we don't have enough cattle out there, and cattle prices soared to the highest they've ever been in history. So the U.S. is probably in a smaller situation between the years of 2013 and 14 in the drought that we had. So it's going to be more difficult to see how producers are able to manage the high corn prices and still a very high feeder cattle price in the future.
Chris, look at our screen here. We have the table of prices for live cattle. The nearbys are at 117 right now, and you have the deferred contracts as high as 130 if you go into late winter. That's a big spread. And a lot of folks are talking about maybe by late summer, they think there could be a marketing hole in the live cattle. Do you see that too?
It's possible. We know that the first quarter placements were the second highest in history. So April placements will be the biggest interest. When we get to the middle of May, we'll get the April numbers. And if the April numbers are equivalent to what they would have been last year under normal circumstances, then probably you could see some holes going forward from there. And then May, as high as feeder cattle prices are, and with the corn price at, you'll probably see a lot of producers tail off in placements on May and June both.
Okay, so that's the situation on cattle. Now I want to switch over to lean hogs, and right now you have everything lower across the board. Let's go ahead and go with June. That, I believe, is where most of the volume is, and we're now at 111.87. That's down 97 cents. How come?
You know, probably the lean hog index has started to trade just a little bit lower back and forth a couple of days last week. As far as the hog production goes, we have been short of hog production ever since this time last year when we had to gas a lot of those pigs there. And we just haven't caught up between the exports that we've been moving out to China and the issues that we had. We had a little PRRS disease earlier this spring, so we've just seen hog prices go up literally every day for multiple days in a row. So to see them down just a little bit like this isn't surprising.
All right. Well, Chris, good to have you back with us.
Thank you. I appreciate it, Marlin.
You look great.
Thank you. Thank you.
Anyway, thanks for joining us, and we look forward to doing more of this.
Absolutely.
Again. Thanks again. Chris Swift of Swift Trading with us live and in person here on this Monday morning. Janet?